Hello friends, welcome to Money Ki Baat Alpa ke Saath. Investors can be broadly classified into three categories. First, aggressive equity funds. Second, conservative debt funds. And third, moderate, those who want the best of both by investing in hybrid funds. Today's episode covers some important aspects of hybrid funds. So what is hybrid fund? Hybrid fund invests in both debt and equity instruments to achieve diversification and get the best of both. A perfect blend of the both offers higher returns than a regular debt fund while not being as risky as equity funds. So who should invest in hybrid fund? Investors who are willing to get exposure to equity market but not fully and moderate in nature, at the same time having medium term horizon like 3 to 5 years are ideal for hybrid fund. Types of hybrid funds. Hybrid funds are further classified based on their asset allocation. Let us have a look in detail. First, equity-oriented hybrid funds. In this, fund manager invests more than 65% of the fund assets in equity and the rest in debt and money market instruments. This is called equity-oriented hybrid fund. Second, debt-oriented hybrid fund. A hybrid fund is termed as debt-oriented hybrid fund if the fund manager allocates more than 65% towards debt instruments. Third, monthly income plan. These are hybrid funds that invest periodically in debt instruments and generally have 15 to 20% exposure to equity. This would allow it to generate higher returns than regular debt funds. Fourth, arbitrage funds. An arbitrage fund tries to maximize returns by buying the stock at a lower rate in one market and then selling it at a higher price in another market. By design, an arbitrage fund are relatively safer like most debt funds. But the long-term capital gain tax are taxable like that of any equity fund. So, arbitrage funds are more tax efficient than the normal debt fund. Things an investor should consider before investing in hybrid funds. First, risk factor. It would not be wise to assume that hybrid funds will be completely risk-free. Any instrument which invests in equity markets will have some risk, especially mark-to-market risk. Second, return. Hybrid funds doesn't offer guaranteed returns, so it may fluctuate due to market movements. Third, cost. Before investing in a hybrid fund, ensure it has a low expense ratio than other competing funds. Fourth, investment horizon. Hybrid funds may be ideal for a medium-term investment horizon, say 5 to 10 years. They bet on price differentials of securities in different markets. Fifth, financial goals. You may meet intermediate financial goals like buying a car or funding higher education for your children with hybrid funds. Retirees too invest in balanced funds and go for a dividend option to supplement their post-retirement income. Sixth, tax gains. The equity component of hybrid fund is taxed like the equity funds. Long-term capital gain tax on equity component are taxed at 10%. Short-term capital gain tax on equity component are taxed at the rate of 15%. LTCG from debt component is taxable at 20% after indexation and 10% without the benefit of indexation.
Hope you have liked this knowledge on investing. You can also buy our book Every Woman Should Invest by Alpa, which is available on Amazon India, the link of which is mentioned below in the description. Please like us, share this video, and do not forget to subscribe to our YouTube channel. Share this video with all your friends and family